As the puzzle pieces come together, the big picture of a potential economic recession is becoming increasingly clear. The 11 sectors that make up the S&P 500 have been telling the story since the start of this year, and it's one that makes more sense with each passing day. In tonight's Stock Market Brief Show, I'll be sharing that story with you, breaking down what these sectors are revealing about the future of our economy. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated, and subscribe to the channel if you like this type of content. Let's get into it. All right, ladies and gentlemen, welcome back. The time has come. The Fed is putting out the signal that we're going to cut. The time has come for policy to adjust, he said, adding that the direction of travel is clear. Nevertheless, Powell all declared victory over price inflation, saying that my confidence has grown that inflation is on a sustainable path back to that 2%. So if you look at the Fed Watch tool, we basically are pricing that in now for the September meeting. There's a 71% probability that will be moving down 25 basis points and about a 28% probability it may be 50. Add those up together and you're getting close to a 100% chance of a rate cut. And people are excited about that. But let me remind you, typically when we go through a rate cut cycle, it hasn't been all too bullish. This is the federal funds rate, and you can see we cut rates here after the hike cycle, cut rates here, and, well, we're about to cut here in September. And if you go back and look, well, the market went higher here, but then, well, that was a pandemic. Let's go further back. Well, this was the great financial crisis. Oh, okay. And before that was the dot-com bubble bursting. Ugh, gross. And this right here is the 10-year, 2-year yield curve. It has been deeply inverted for a long time, and it is starting to move towards that path of uninversion. And if you go back through history since we started to invert back here in July of 2022, you'll notice that the deeper inverted we get, it actually helps the S&P 500 out. But when we start to uninvert like we did from July of 2023 till about November or late October, the market actually went into a correction, being about minus 10% or so that was. And you can see many times it went up, and the market went consolidated or went down. And more recently, we saw a large move in the 10-year, 2-year curve trying to get to that uninverted space. And the market took a big hit on the chin from around 560 and some change down to about 520 in a very short period of time. And since that point, you can see the yield curve came in and the market started to rally back. Now, let's get a little bit more into detail about what I mean about the 11 sectors that make up the S&P 500. This right here is looking at cycles. The orange is the stock market cycle, and then the blue is the economic cycle. And what you'll notice here is that the orange leads the blue, right? You typically top out in the stock market before you run into some economic troubles. That is basically saying that the stock market front runs, right? It discounts what can potentially happen later. Now, I'm highlighting here because typically when you start turning from the top of the markets, right around here, you start to see things like consumer staples, utilities, real estate, financials, and healthcare start to perform better. And this also coincides with being roughly at around the tops of an economic cycle and for the turn of moving into what's known as the early recession. Now, you might be thinking, okay, but we have a huge bounce back in technology. What do you mean? Well, if you actually look at the last 3 months, just 3 months, look at what's starting to take shape. You have real estate up 17.25%. You have healthcare, consumer staples, financials, and utilities. And if you go back over here, you got consumer staples, healthcare, financials, real estate, and utilities. Okay, so that's all performing very well. And you might be thinking, well, but energy, energy wasn't, well, what about energy? Energy's coming off. And that typically marks around the market top. And you're right, energy and materials typically mark the top. But if you go back to where the year started in early January to April, what was the top performing sectors? It was energy and it was materials. If you go back like the very start of the year, pretty much the only thing that was really performing to April was Energy. So from the start of the year till about April, right? Boom, you started to see these assets perform. And now what we're starting to see for these last 3 months is things taking shape a little bit further down in these 5 sectors. Okay, but Mike, the stock market's at all-time highs. And I'd say, yep. And I would say, don't fight that trend because the markets can continue to go higher. And we talked about when the market sold off here of what to specifically look for. And what we were specifically looking for was that specific day, known as a follow-through day. And then shortly thereafter, we got another follow-through day. This led us to get exposure back into the markets. And now we're continuing to press higher. We're getting some consolidation up here. It's still getting tight. We haven't been shaken out or tested at all, which still may come. We did get one distribution day right here. Just like over, if you look through the past over here, we started to see 1, 2, 3, 4, started to see multiple distribution days build before actually selling off. And this is where it gets interesting because a lot of people that don't watch these videos, they'll be like, okay, well, you're just bearish. No, I'm not bearish. Actually, I would encourage you to ask anybody on YouTube to show you their P&L curve for the last year or more or less, whatever. I'm showing you right now, just this year, of both my 401k, or not my 401k, my SEP and my Roth IRA. This is dating back from August 25th, 23 to August 23rd, 2024. And you can see here in August, this was August, right there was August, there is no volatility in my portfolios because I prepared for that. I saw what was coming, and I'll walk you through exactly what that was. And if you look at the performance from the last year, showing performance data through August 23rd, you'll notice that my 1-year cumulative return is 63%. My 1-year previous on my Roth IRA is 79%. And if you heard of the United States Investing Championship, I am going to be sharing my SEP IRA year-to-date performance verified through them. Now, it's not a 63% year-to-date. It's more like almost 40, like 36, 37, somewhere around there. And I'm not saying this to brag. I'm telling you this because if the market's going higher, you want to participate. When you see good breadth, you want to participate. But I'm also telling you this because take a look at this chart. When the market sold off into August, we bounced back and we got new all-time highs. Do you know when this was? This was in 2007 going into 2008. And yeah, it's roughly around the same time. We actually peaked here probably right around the same day in July. We sold off, we came all the way back, and it wasn't until October where we started seeing volatility. And well, we knew what happened there, right? That was right here that we just watched. And then it came all the way down. Not to say that that's going to be the same case, but there was 11 sectors still in the S&P 500 back then. What were they doing up here leading into July? Well, guess what? Leading into July, energy and materials was the leaders of the market, just like we just previously stated, which happened up until around April 5th, where things started to change and we started to see more performance come out of these 5 sectors. Interesting, right? Interesting story. Good narrative right there. Okay, but Mike, does this mean I short? Does this mean I get out on all my positions? No, that's not what this means. So how do I approach it? There's a couple of things I look at, and I talk about them on every single Stock Market Brief show. I talk about the gamma flip line because gamma is incredibly important in the structure of these markets now, and this flip line tells me how dealers are going to start acting. Are they going to act a fool, or are they going to act how I want them to act? When we're above the gamma flip line, you buy the dip, you sell the rip, buy the dip, sell the rip, right? Volatility typically comes in. But when you're below that flip line, well, they sell into selling, they buy into buying, they sell into selling. You get wild price action and volatility typically increases. And right now we're pinned roughly at around this 5,600. You can see that has been a key level for some time. And I kind of drew it down to where the current gamma flip line is. This is going to change as more time proceeds, but 5,560 is where it's at. So I'm still bullish above these areas. It's if we start crossing down through these, well, I got to start trimming out some of my positions or I'm probably going to start getting stopped out of quite a bit of my positions. And then I also look at the 15-minute time frame, and I look at the 5-day moving average. And the 5-day moving average for the S&P 500 is still inclining right now as price action is kind of getting hung up right around this 562 area, a little bit higher, 563. We're putting a series of higher lows in. It's consolidating, but the more we trade around here and we don't break to the upside and we potentially expand to the downside, the 5-day moving average has the ability to start curling back around, which could be a potential change in trend. Actually, if you look at the Qs right now, the Qs are below the 5-day moving average. It's starting to flatten out, and we're bumping our heads on the week to date, which is basically today's daily anchored volume weighted average price. So if you are bullish the NASDAQ 100 and tech, you really would want to see price to reclaim that 5-day moving average and for it to start to turn back up. Because in the S&P 500, guess what really leads the way? It's the growthy names and the large market cap names, which happens to be technology stocks. Now, if you don't know what these other levels are, these are the daily and weekly expected moves. So if you want to screenshot this and put them on your chart for this week, and this is for tomorrow, which is August 27th, you can do so for that. And then also the Qs, I have them up here. If you can't quite see it, I apologize. I've been trying to make these bigger, but it is what it is. Let's continue on. And I want to point out this is the dollar. And the dollar is also a very important asset from an intermarket standpoint. And on a weekly chart, I wanted to show you that the Bollinger Bands are expanding. Okay, right? When things contract, things typically expand. And price action of the dollar has been getting beat up. So much so that we're actually outside of the weekly Bollinger Band as it stands. And you can see we've done this before. And each of those times, well, we actually snapped back. Now, why would that be important? Well, because the fall here in the dollar has really propelled the S&P 500 up further. There's typically a negative correlation. So if the dollar does start bouncing back, is that going to put pressure back into the S&P 500 and various other assets like potentially gold? And I think that that is a valid concern and something that we need to watch for. Another thing to pay attention to is obviously the 10-year yield. So if we take a look at the 10-year yield, the TNX, we saw some volatility come in, and now price action is kind of just consolidating here as the price momentum oscillator looks like it's about to have a bullish crossover. And this to me is a little interesting because if we do get a bounce here in the 10-year up to and around this 39.5 or 4, which means, 3.9% in the 10-year to 4%, what is the 2-year yield going to do? The 2-year yield is this red line, and that tracks closely the federal funds rate. In fact, you can see the times that we cross underneath it, it marked the times where the Fed stopped raising rates, and then they began to cut shortly thereafter. And you could see that from 2000. You can see that in 2006 to 2008 going into that recession. And you can even see that here from 2018-ish, 2019 going into the pandemic area. And right here, you can see the 2-year yields coming off. It's roughly just under that 4%. Okay, just under that 4%. And the yields, we have yet to cut rates. So this is signaling that they are going to cut rates. So if the 2-year yield comes in or maybe bounces a little bit while the 10-year yield bounces up, what this will do would be it would move us closer to uninverting the yield curve, which takes us back to this chart, right? The 10-year, 2-year, which means if the 2-year comes in, the 10-year yield stays where it's at or bounces, or the 10-year yield bounces and it bounces past the 2-year at a more rapid rate, this will begin to uninvert like it did over here in 2019 going into 2020, over here in 2007 going into 2008, and then over here in 2000 like it did going into 2001. Now, why would I think that the 10-year yield could potentially bounce? Well, there is something known as oil, and oil, surprisingly enough, has kind of led the 10-year yield. You can see that when oil, the black line, went down, shortly thereafter, the green and red candles, the 10-year yield, started moving down and following. You can see when oil started to bounce, shortly thereafter, the 10-year yield bounced. You can see right here, they started catching up. But right here, right now, what are we seeing? We're seeing actually oil start to bounce these last couple of days, and the 10-year yield has yet to do so. Now, that doesn't guarantee anything, but what we are seeing in these last couple of days is oil starting to bounce. Another thing to pay attention to is this compression pattern, right? The Fed is trying to fight inflation, but if we have agricultural goods, things that we buy, and they start rising, which they did today, if you look at a couple ETFs, and oil, which is a huge, huge component of our everyday lives, if this starts moving higher, inflation for the everyday consumer gets more expensive. So as we're seeing oil start to rise, it's still within this compression pattern. And if it does decide to break out to the upside, is the Fed really where they want to be as far as inflation concerns go? And I'll leave that for your decision. Now, why would this be important if the 10-year yield and the dollar both rise? Well, because if you actually look from a year-to-date perspective, what do you notice here on some of the market stuff that I watch from an intermarket perspective? This right here is the 10-year yield, the TNX. And then right here is the dollar. This is the only things, versus the TLT, and then also this is the yen, right? But these are the only assets here that are actually down, not the only, but the only assets that I'm tracking here from a year-to-date perspective that are down, and everything else from Bido, junk, various sectors, right? All of this, semiconductors, so forth, down the list are all in the green. So if we are right and accurate to say that the dollar may bounce and the 10-year yield starts to move and oil's giving us insight, one may think from a shorter term perspective with those assets going up, it could put pressure back onto the markets. Now, with that said, we do have a lot of stuff coming out this week. We have NVIDIA after the close on Wednesday. I think the market's going to be pretty paused out until they really see what that does, because right now NVIDIA is one of the largest market cap names. It recently just took out Microsoft as the largest market cap name. I don't know where it's at right now, but the other day when I was watching it live, it did do that, which was pretty intense. And the implied volatility, it doesn't need to be the largest market cap, but the implied volatility is the largest. So this little guy this big guy is the market. So if the market doesn't like what NVIDIA does, that could put pressure back into the markets as well. Not only that, but we also have on Friday, we get some personal income, personal spending, core PCE data, and these type of things bring in volatility to the market as well. On Thursday, we get some GDP growth rate numbers, and we have Fed speak as well throughout the week. I want to go over a couple of signal charts that are taking place that I thought would be of interest to many people, because a lot of people are noticing NYA, right? The New York Stock Exchange. Many small caps have been seeing a bounce, and we just hit another highs on the NYA. But the internals are actually a little bit weaker. Right now, you can see we have a high to a lower high, and I'm just going back. All the red lines point that out where we got higher highs on the price action. But those divergences all led to consolidations and little sell-offs. And then the same thing happens on positive divergences, right? Where we see markets rip, markets bounce, markets rip, right here, all those green lines. So I just wanted to call out that this 150 level on the NIMOT, which is the Nising McClellan oscillator, is somewhat in oversold conditions. And then you pair that also with a negative divergence. It could be telling us that we may be in for a consolidation or pullback in the very near future. Another aspect is if you look at Dow theory, Dow Jones Industrials just had a new all-time high, which is not actually bearish, right? But the transports have yet to follow. So either the transports are going to play catch up, or they're going to do what they did in the past, where transports gave us a warning shot that they were putting in lower highs while the Dow Jones Industrial was putting in higher highs, and it obviously came back down. It came back down. More recent one was right over here, and now we're back to that same divergence. Another interesting aspect here is looking at growth versus value. And when this big sell-off occurred in the Qs, we got very overextended on the rate of change between growth and value. But when we started crossing back above that zero line, see if I can move that up straight, you can see it was right around there. That actually kind of signaled that, hey, things are coming back in to play on growth, and we saw this move up. Well, now we're starting to see the rate of change come off a little bit from an oversold condition, and if it crosses below zero, there's been many times that when you cross below zero, it does indicate that we could very well see weakness. You've seen it multiple times where we saw big moves and then we saw some weakness. There's a lot of whipsaws in this, but I thought it'd be important to at least point out that the value trade is starting to pick up a little bit from a rate of change perspective over the growth. The last one I'll close with here is the old fool indicator, and this is taking the put to call ratio. It's actually taking the NASDAQ composite and dividing it into the total put to call ratio. That's that purple line in the back that's all choppy, and we smooth it out with some EMAs. And you can see the green is the shorter term, the blue is the 50 EMA. And when you have a crossover, it's worth noting. Now, this is a highly lagging indicator, but you can see the last sell signal was right here, and we rallied back up and we sold off. Over here, it was a lot of chop, so you can ignore this signal or just say that, I started getting much more clear of a picture over here, and we started moving up, and it was kind of a choppy picture here, which basically just chopped us around. And then recently, we had the sell signal here. The market's bounced up, but you can see as it stands right now, it's a little choppy, but it is still on this official sell signal. Now, this can change very quickly, but I figured I would point that out. That's all I got for you on today's Stock Market Brief Show, everybody. Hope it helped out. Those were the 11 sectors, what the story was telling about the potential for an economic recession, and what specifically I'm looking for. Once again, that's the gamma flip line in the direction of the 5-day moving average to make sure that I'm on the right side of trade or just out of the markets while turbulent things can potentially happen. And when the opportunities come, I'll be right there, ready to go. See you later.